We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of the SRSrocco Report. Steve, thanks for joining me again today.
Tom, been a while, a lot going on. Today we had the Fed chairman talk. We see the markets take off today. So yeah, it's great to be back. Good to see you and a lot to talk about.
Absolutely. I mean, there's tons to talk about since the last time we spoke. Of course, today we're recording this on Wednesday, December 13th. Mm-hmm. This probably won't air until Friday. But yeah, big move in gold again today, back up on a little bit of the dovish stance, it seems like, from Chairman Powell. We're speaking about 1 o'clock Mountain Time. So I believe he has yet to deliver his entire press conference, Jay Powell, but we'll see how the market moves there. But, you know, with the move in gold back to the highs and seeing the first monthly close over $2,000, we should be filled with optimism and joy, right? But I want to get your perspective on this move, zooming out a little bit. So from your standpoint, is this a sustained move, and what would confirm this precious metals rally?
Tom, it's a good question. When you look at the gold price over long term, it's interesting. If you overlay it with the global gold ETF flows in and out, it tends to be a pretty good indicator. Now, some people would say that shouldn't be, but I could see if it was 1 or 2 years, but it's done this up until last year. And it changed last year. We start seeing outflows of gold in the last part of 2022, and that continued into 2023. But you know who started buying more gold? Was the central banks. So that put more of a bid. But what happened more recently, that tends to be the inverse dollar trade and options and futures. Because I can tell you the institutions and high net worth individuals and retail are not going into the ETFs. And you talk to most precious metal dealers and wholesalers, there's more selling. They're not buying. So this is more of a futures paper movement of gold. That's why it went up and thin trading to 2130, and it's come all the way down. And then today, what do you see? Powell opens his mouth. The stock market's up 350, gold's up $300, silver's up 75 cents. So I think this is these paper digital futures moving around algorithms. That's what, and I don't think it's sustainable on the short term. We can get into that into the next chart, which I think is important.
Absolutely. So are there negative divergences here in the gold chart that gives you pause, Steve?
Yes, if you look at this chart now, I'm not a professional technician. I spend time looking at it, but when I saw this is a monthly chart of gold, and you could see, the RSI has been coming down over the past few years, and even the MACD. And so, even though the gold, it's not a massive divergence, but when you see this last rally, that to me just gives me caution. Now, let me put a footnote. If we have any banking crisis, any financial crisis, we get China decides they're going to attack Taiwan, or this Middle East thing really blows up. Well, it changes the entire dynamics. Just like Fed Powell opened in his mouth, we could see there's major moves in gold. So if we don't have that, Tom, if we don't have any geopolitical or major financial problems, we could see lower metals prices into next year if the economy starts to roll over. And so I just want people to keep that in the back of their mind, because this chart kind of made me concerned. And it's also the gold miners are making they're making good profits right now. And so when you look at this, I'm just saying, if we don't have any major events in the markets, we shouldn't be surprised. Let me put it that way. We shouldn't be surprised if we get a weakness in the metals prices, especially gold.
So Steve, are you, I'm just trying to piece together exactly what you're saying here. Do you think we're going to get a weaker gold price without these exogenous kind of fear-driven buying events into gold? And then if we combine that with a recession, that we end up having gold sold off because you end up selling whatever you can to meet, let's say, margin requirements or just, rent and whatever else you might need to cover in the event of a recession?
Well, there's two ways to look at it. A lot of investors are getting out of their deposits in the banks, and they're going into treasuries to get that 5.5% yield. They're going into money market funds because most people they don't want their money to sit there and do anything. They were forced when we had zero interest rates. Now that interest rates have gone up to 5.5%, they're trying to take advantage of that. So we're seeing that in the gold ETF flows. Investors are selling gold, and they're moving out and they're getting into financial assets. And so that's one aspect that has pulled that demand away from the institutional market. And also we're seeing the same thing with retail bullion investors who are selling gold and for various reasons. And they're likely maybe moving into earning a yield. If you own a lot of gold, you likely store it. You've got to pay storage. So we need to understand that dynamic. And so again, unless we have a major event, if we don't have again, we shouldn't be surprised to see the gold price. It could become weaker, especially because look at the gold price has gone up with the Dow Jones today. Everything's gone up. So they can go up together, they can come down together. And especially with the profits the gold miners are making, there's a big margin there. And so we've seen that compress over time.
Mm-hmm. Yeah, we'll get into that, because that's something that you and I have talked about before, is this idea of the cost of production driving the gold price higher. So
Right.
Give us a little bit of a refresher on that dynamic. And is it a case of the cure for high prices being high prices?
Well, you get the gold price. Let me just, before I say this, I do believe there's a lot of money being printed, a lot of treasuries being added, and that's just good for gold and silver. However, it isn't yet, because Americans and pension funds in the United States have purchased $2 trillion of U.S. treasuries in the last year and a half. So they didn't purchase gold, they didn't purchase silver, they purchased treasuries. So the precious metals are competing with that market. And so when you look at this chart, this is my analysis of the top gold miners' cost of production. And right now it's about $1,650. And with lower oil prices, it's better. But if you look at the price now, about 2000, they're making $350 profit. They're making about a 21% profit margin, Tom. And when they have done that in the past, that's kind of a high. And then, we could see that start to decline where the gold price comes down and the margin compresses. And I'm saying that could happen when the economy rolls over and there isn't any major geopolitical or financial banking event. Mm-hmm. If we have one of those two, then we can see, again, much higher gold prices.
So how does the price of oil factor in here, Stephen, and its behavior over the last 2 weeks? That's obviously a major input into gold mining.
Yeah.
So how does that factor in as well?
Well, in the third quarter, that information on this chart for the 1650, that's based on the third quarter. Mm-hmm. Now, since then, and which I called it wrong. I thought we would see higher oil prices. We didn't. Oil prices actually have collapsed down mm-hmm. to below 70. That now, in probably the next quarter, is going to start lowering the cost, the production cost, so it could actually fall. And so then the margins are going to be, if the price of gold stays at 2,000, then the margins are going to be even better. Mm-hmm. And so we've got lower natural gas prices, lower oil prices. That's just better for the gold miners. Unfortunately, we'll talk about this too. Investors aren't really buying the gold miners, even though their margins are better. I find that fascinating.
Well, we've spoken before about margins and about the idea that they're being compressed. And the idea of the AISC, or the all-in sustaining cost, comes up. Right. Is that the best way to measure the cost for production of a company?
I don't think so. And this started a few decades ago. For decades, they did the cash costs, and everyone believed the cash costs. And then they realized that wasn't that wasn't the real cost. It was they did the all-in sustaining cost. And so that's what they do now. The silver mining industry, gold mining industry comes out with this all-in sustaining cost. So now if you look at Barrick here, you see to get their $1,352 all-in sustaining cost, they have omitted what is known as project capital expenditures. And you can see that. They have sustaining capital on the top. They include that when they figure out their all-in sustaining cost. They exclude their project capital expenditures because they call this developmental or expansionary. If you add that, just that alone, which was $691 million for the first 3 quarters of this year, you bring up that all-in sustaining cost, which was $1,345 for the 9 months, it comes up to $1,557. Mm-hmm. So people say, well, that developmental shouldn't be included because they're increasing production. Well, if we go to the next chart, you're going to see, well, for Barrick, that hasn't been the case because this is Barrick's annual gold production from 98 to 2022. And you don't need to be a brain surgeon to see that their production's been declining. So even though they're doing expansionary developmental capital, which lowers their all-in sustaining cost, they're artificially lowering what it really costs because they're not increasing production. It continues to decline. If they were doing developmental and we can see higher and higher production, now some companies are doing that. It's not across the board, but some companies are using developmental. They're slowly building, but they get to a peak. So I use the adjusted net income as a percentage of the profit, and I confirm it with the free cash flow profit per ounce. And they tend to confirm each other. And so that's my analysis. And so I go by the 1650, not the 1354 that Barrick says, because they are excluding all the costs. They are excluding some costs. And I call that all-in sustaining cost, Tom. I call that the going out of business sale. And why would you invest in a company if they're going out of business? And so that's the difference between the industry that uses that all-in sustaining cost and my total cost, which is 1650.
So, Steve, is it more a case of they don't have as high of grades and that is hurting their production? Do you think it's, they're waiting for a time when gold, has a lot of momentum to replace those ounces? Is it inefficiencies? Is there somewhere that we can kind of point to understand where that fall in production is coming from?
Well, we're seeing other companies that are starting up, smaller mid-tier companies that are, taking up this, let's say, supply that's maybe some of the majors are losing, like Barrick. But the issue is, you go 100 years ago, and you can get 20, 25 in some places in Australia, 30 grams per ton. We're almost talking an ounce a ton. And so if you were a mining person today, a geologist, and you got transported back in a time machine to a saloon, and you're telling them how you got a high-grade gold mine of 3.5 grams per ton, the whole bar, all the gold miners would be laughing you out of the bar because they won't even touch that. And so it was due to bringing on oil, we were able to build these massive haul trucks to extract this very low quality ore. Mm-hmm. And so even though we are finding some more grades, some more deposits, 3, 4, 5 grams per ton, it's still very costly. And so again, it's really not changing. And I look at the top 6. And Tom, it's these top 6 average about 1650. And if you go back to 2004, that was $400 an ounce. And now it's 4 times. That's why the gold price has moved up. A lot of people don't get that, like Harry Dent Jr. He doesn't understand. If you want to buy gold, you're going to have to pay what the gold miners it costs to produce it. Mm-hmm. So that's how I look at the market.
So, Steve, what do you think really explains the movement of the gold price here? Is it manipulation? Is it selling the futures contracts? What do you kind of attribute that to?
This is a big debate between the manipulation theory and the not manipulation. Well, the central banks are manipulating. If Janet Yellen can add $3.5 trillion in new treasuries and debt in a year and a half,
Mhm.
That's 3.5 trillion. The global mining industry added about 400 billion of new gold in that 1.5 year period. But it cost them like 350 billion to produce that 400 billion of gold. The Secretary Yellen didn't cost her anything to produce those 3.5 trillion in new treasuries. Now she's going to have to service those treasuries, which is 60 billion of extra service cost. But this is the issue that I think the market is now, and we're seeing a lot of options trading. There was a chart on zero hedge. It's over 60 billion now in options. You go back a decade, it was 4 or 5 billion. We're seeing a lot more leverage. I think the leverage, the algorithms, the futures trading is pushing these prices around a lot more volatile. And again, as I mentioned, we're not seeing much gold flows into the ETFs like we were during the pandemic shutdown, during the Russian-Ukraine war. In the last year and a half, we're seeing more net outflows. And again, we're not getting a lot of buying from bullion investors. They're mostly selling. So it just makes sense to me that right now it's a lot of very highly volatile futures leverage trading that's pushing the price around. That's what it seems to me.
So Steve, as we're talking about the profit margins of the miners, if they're still relatively good, what do you think explains this weakness of the miners relative to the gold price? I've had a couple of people weigh on this, and I'd like your 2 cents as well.
Yeah, and there's a chart on that, which is pretty interesting how the GDX, the gold miners ETF, if you look at the gold price, it's the gold price and the gold miners ETF, they have separated it started about May 2022, and it's gotten worse, much worse. And so I could see this back at the end of 2022. Why? Because oil prices had skyrocketed. Oil had gone up to 120. Natural gas in the United States was over $9. So it was really eating into the profits of the gold miners. Costs were high and the gold price was falling. But now we're seeing the oil prices have been declining, and you see the difference between the gold miners ETF line chart and the gold price. It's separated. So 2 things are going to happen. Either the gold miners are going to start moving back up to match the gold price. That could happen. But the Dow Jones now is getting very overbought. And typically the miners follow the Dow. They follow the broader markets. And so what is going to happen? Is the gold miners going to start moving back up to meet the gold price, or is the gold price going to start coming back down more to meet the miners? Some are suggesting that miners aren't confirming this gold price rally. And I don't have the answer, but when you look at this chart, 1 or 2 of those things are going to happen. And to me, when you look at this is more futures and options trading and leverage, and if we do get the downside in the markets into 2024 and no major exogenous events, then I think the gold price is what's going to come down more to meet the miners. That's just what I think. I could be wrong, but that's what makes more sense to me.
As I think about that, though, Steve, we hear that the central banks are buying record amounts of gold. So,
Right.
If there's record demand from the central banks, is that not at all being matched by the rest of the market? And that's why, Nat, we don't have the demand to keep driving the gold price higher, or barring an exogenous, news event.
Well, you bring up a good point, and I did a report on this for my subscribers. I looked at the World Gold Council, and each year they have all the demand, and I don't have a chart for this, unfortunately. They have all the demand, and then even the ETF demand, whether it's inflows or outflows. Well, in 2020 and 21, you had good demand, but the over-the-counter market was buying. I think in 2020 during the pandemic shutdown, even though we had a lot of buying of physical, 1,000 metric tons was purchased by the over-the-counter market, whoever they are. And then it fell in 22. And so the thing is, even though we're getting central bank buying, as I mentioned, we had about 400 no, 350 billion of buying globally of gold in the last year and a half. You had 2 trillion of Americans buying treasuries, and Janet Yellen adding 3.5 trillion. Now you start adding the rest of the world. China's doing it. The ECB is doing it. Japan. So a lot of investors are going into these financial assets to gain a yield. When they realize that these treasuries may not be, they be risky, that's when you start to see a lot of gold come out of the over-the-counter market to feed not only bullion demand, ETF demand, central bank demand. When they all come together and start having a lot of demand due to we start getting problems in the treasury and bond markets globally, that's when the prices become sustained higher. And I don't see big declines then. I think the market goes into changing from building wealth to protecting it.
Well, I'd like to get there, Stephen. Let's say the issuance of treasuries. I know we have a chart for that, but I wanted to ask you if the silver miners, and silver is in a much different position than gold.
Yeah. Yeah, unfortunately, the silver miners, and there's not that many of them compared to the gold miners, their cost now, or in the third quarter, was like about $22.50. And unfortunately, with the silver price right around the 23, 24 range, they're probably doing a little better now, or they will if the oil price remains low in the next quarter, if silver prices stay at 24 or whatever. But they were breaking even. Matter of fact, all except one of the primary silver miners, Hecla, Andover Silver, First Majestic, they all lost money. The only one that actually made a profit was Fortuna Silver, but that was due to they have 3 gold mines now. And so about 73 or 4% of their revenue is now from gold. And so they did pretty well with these gold mines, but all the primary silver miners actually lost money, Pan American Silver, in the third quarter. So it just goes to show you the primary silver miners are struggling while the gold miners aren't. They're not struggling. Why? Because there's that big gap, that margin. And it's that gap is still there. The silver miners maybe have a little bit, $1 right now, but that's not much. They would need to see $28, $30 silver to have the same kind of margins that the gold miners are having. So you could see the difference.
I want to go back just to kind of clarify something in my mind, if we could.
Sure.
The idea that, let's say, the ASIC shows us a certain, margin for gold. And then if we calculate the total cost, that's different. So are you calculating that the margins are still relatively good for the big gold miners based on their total cost or the ASIC?
The total cost, because that's the real, because even though it's developmental capital that Barrick spent almost 700 million, they still spent that money. They didn't, it wasn't printed. It still costs them. That's still a capital expense. They just conveniently try to keep it away from what their costs are. And the whole mining industry does this. But now what you're seeing is, and I showed you, they had the total cost. I think we're going to start going to the total cost, which isn't really all the cost, but it's better. It's better than the all-in sustaining cost. So we went from cash cost, we went all-in sustaining. Now I think the mining industry is going to wise up and include the developmental in the whole thing. And that's going to increase the total cost even more than the all-in sustaining. And so, the real cost for the gold miners is $16.50 because they're still investing that capital. And I just showed you, Barrick isn't increasing production. They're just replacing mines that they're selling or production that they're losing. And so this is what we need to understand. And the mining industry isn't really growing overall. A little bit this year, but overall, we're not really seeing a lot of growth in the gold mining industry.
Mm-hmm. So, Steve, we were talking about the idea that this growth in treasuries is just going to keep going here. Are central banks going to be able to keep issuing debt to finance their spending? And as you see it, what could limit that ability going forward? Yeah,
that's the $1 trillion question. And
maybe a couple more than 1 trillion.
Yeah, that's the quadrillion-dollar question, and we do have a chart for that. The thing, this is the issue. We had Fed Chair increase the Fed funds rate by 5.3%. And that's what he did to stop inflation. And so you get it. At the same time, Janet Yellen added $3.5 trillion of debt. So they're fighting each other. Mm-hmm. And so that's why the markets aren't rolling over. And so in that chart, you see that the gold price. Okay, this is what we need to understand. I started in 2007 because that was the global financial crisis. Mm-hmm. And I put everything at zero. And what we have here is the growth of U.S. treasuries. And what do you see? By the end of this year, it's going to reach about 21.4, 21.5 trillion extra. And you have to remember, we started at about 5 trillion in 2007. We've increased it to 21.5 trillion. Look at the U.S. gold reserves. If we go by what we supposedly have 8,135 tons. The increase in the gold reserves, if you put a $2,000 gold price, is about 320 billion over that same period. So if you divide the increase in the treasuries by the gold, it's 66 times. Now, someone owns those treasuries, and those treasuries continually have to be retired and then reissued. That gold stays there. It doesn't have to be retired. It doesn't have to be reissued. This is the problem. Now they're going to continue to issue more treasury, but when you see, and this was interesting, the November treasury statement, it's a 315 billion deficit in 1 year, in 1 month. Mm-hmm. I just saw the U.S. Treasury monthly statement for November was a 315 billion deficit. How long can you continue doing that? And how long is someone going to continue buying these treasuries? And so it's going to continue for a while, but we need to understand the U.S. Treasury prints these assets or supposed assets. I call them liabilities masquerading as assets with no cost. They didn't manufacture them. They didn't extract them and mine these treasuries. They just printed the treasury, and now they have to finance that treasury, right? The service cost. But the gold miners are providing real assets because it's the cost to bring that asset to the market. The treasury, there's no cost to bring that asset to the market. It's basically free. And that's the issue that the market doesn't understand. The institutional investor does not understand these problems with these financial assets. And that gets into trouble, Tom, when we start to hit that energy cliff. And that's why they'll likely continue doing this for a while, but it's going to become unsustainable because I think it's going to be hard for the market to continue to absorb this kind of debt treasury bond growth.
Mm-hmm. Yeah, I find it interesting to look at this chart of real GDP growth versus treasury growth. And it almost reminds me of like a teenager that got a credit card and, his salary is growing a little bit year over year, but yet his debts are exponentially starting to increase much more over his actual income.
Yeah, and I went to the Silver Symposium at the Caesars Palace in Las Vegas in October, and I have a chart globally, and it's much worse globally because the real GDP over the same period in the globe increased 28 trillion, and that was inflated. This is also inflated, even though it's real GDP. Well, if the GDP globally increased 21 trillion, Tom, the financial assets increased 281 trillion. Mm-hmm. That's 10 times. So I've been a broken record, but it's important. We just have enough energy to produce the goods and services. We have the oil, natural gas, coal, the nuclear, the hydro, wind and solar, all that energy, and we make all these goods and services that we deliver to the market, and we all buy them. That's what the energy is there for. We don't have the energy to settle that 500 trillion in financial assets. Mm-hmm. It's very inflationary. And so this is what the market doesn't understand. We just have enough energy to do the GDP, which is going to start to peak, plateau, and decline. So that's why I'm trying to wake up people to understand why they need to be in sound assets. And the financial assets are going to get into serious trouble because it's a Ponzi scheme. And the reason why it's a Ponzi scheme, because we don't have the energy to settle it. And that's what it comes down to.
Mm-hmm. So, Steve, with so much in the form of renewables coming into the grid, will that help make up for this power loss or for the loss of power generated from coal plants in the US?
Okay. Yes. Right now, the renewables, as we grow them, we don't have to burn fossil fuels. We don't have to burn coal. We don't have to burn natural gas. And so, yes, as we grow, especially in Europe and now the United States, we don't have to burn the fossil fuels. And that is going to continue. The issue is the one big problem, and they're trying to offset this with battery technology, is that as the wind and solar go up, the larger percentage, when that goes offline, you have a larger amount of that going offline that you have to bring on natural gas. You can't really do it with coal. Nuclear is stable. So it's very volatile. And so that's just going to get worse as time goes on. And wind, to me, Tom, the wind power is the worst of the two. Solar isn't as bad as wind. Wind is much more problematic because the technology is too expensive and too complicated. And we're starting to see big problems with the wind power industry.
Well, it's funny that you bring up the idea that we're not going to have to burn oil, let's say, or natural gas to produce that energy, yet to bring enough of these renewables onto the grid all requires fossil fuels to mine, to produce, to transport to the fields. It's only once they're implemented that they start production. I think that's a huge step that maybe a lot of people don't think about. Probably not a lot of our listeners on this show, but that's a huge chunk of getting to that end state that I think is really forgotten about. It seems like you just snap your fingers and you have a solar panel array or a wind farm that's already running and producing quote unquote clean energy. But it's the other piece of it, of what it actually costs to produce those panels, to mine those resources out of the ground, that I think a lot of people forget about.
No, they do. I call it, we've made this joke before, the Amazon Star Trek economy. You push a button and 2 days later you get your package in the front door. No one sees the entire system to get that there. And so it's the same thing with green energy. All of a sudden you got a new solar panels up on your home and producing a power. But this is how I see it. They're going to continue to ramp up green energy. And it looks like we're switching more towards solar, which is the better alternative if you're going to do it. So what we're doing is we're adding more and more, ramping it up. The problems are going to happen in the future because right now, the more you add, the less you have to burn in either coal or natural gas. And so, but when you've got to replace that wind turbine in 15 years, when you've got to replace that solar panel in 20 whatever years, then, and oil production is declining now, it's going to be difficult to replace all that. So it's going to be a lag. It's going to kind of offset fossil fuels burning to produce electricity. It's going to do that. But there's going to be a lag effect where it's going to come back to haunt us. That's what I'm trying to say. It's kind of an illusion now of helping us, but it's going to be a downside in 15, 20 years. That's how I see it, unfortunately. We're not going to be able to maintain a lot of that in 10, 15, 20 years.
Steve, you've done so much research in these areas. Do you, off the top of your head, remember, let's say, how much time it takes to replace or to offset the amount of energy that went into producing, let's say, a solar panel or a wind turbine, understanding how much time it takes to offset that cost of energy?
Well, it's interesting when you look at the shale industry, the conventional, these things are so profitable, these oil wells from years ago, and still some of them are. So the profits are there, and then they go on for a long time. You pay off that well in a very short period of time because it's very profitable. The shale is different. It takes 15 years sometimes just to double your money. With the wind and solar industry, I've looked at a lot of cash flow analysis, the cash flow analysis, and these things sometimes don't pay themselves off. The only reason why they work is due to the the subsidies.
Mm-hmm.
And so I think this is a big issue. And so even after 15 years, like especially we're seeing some in Ireland and the UK, they're not even paying for themselves. So that's a big problem. But they may not pay for themselves, but at least they're providing the power that either Ireland or the UK is not using natural gas or coal. But unfortunately, the economics are still not there for this technology.
So does this shift in energy production also factor into your idea about the energy cliff? Or is that more about the quantity of actual reliable energy that is out there?
It's both. There's like people say the wind and solar have a much higher energy return on investment. And that's not including the full cycle costs. And they really don't, because we have to factor in the entire global supply chain. Mm-hmm. And what we tend to forget, the decades of time binding, all this technology and all these people going to college and all these scientists and all these people putting together engineers to get where we're at today. We want to forget all the energy that we spent in the last 2-3 decades. You had to spend that energy to be able to make that very advanced solar panel. So when you look at it now and you cost it out now, you want to exclude all that prior energy investment, whatever it's labor or knowledge or capital, whatever. And so the energy return on investment, a lot of these alternative wind systems, solar, they're offsetting fossil fuels, yes, but they're not changing the overall dynamic. It's kind of a sleight of hand, and unfortunately, it's not a good sleight of hand. So I think the best thing we need to do going forward is just become a lot more efficient with the energy we use. That, to me, is the biggest. I think we're going to see companies go into efficiencies of the energy we have. That's a new market I think needs to develop. How to become more efficient with the energy that we consume. Well,
Steve, that seems like a real double-edged sword coming into Christmas time when everybody's plugging in Christmas lights and buying all kinds of extra crap that nobody needs. That's just unfortunately, one example, I think, of, I sound like a total Scrooge here, but of a real waste of energy that is something that we really take for granted, unfortunately. And until we really start to face higher costs, I don't think that really brings into frame, like into focus for a lot of people, how important energy is.
Yeah. And, I don't know about you, but those damn Christmas tree lights or the Christmas lights you buy, a lot of them come from China. And I can assure you those things, if you buy 4 strands next year, likely one won't work.
Yeah. And
by 5 years, you got to buy all new ones. And so we're continuing to buy this stuff and throw it out. Mm-hmm. And so we don't realize how much energy it takes. And I've said this before, China produces and consumes half the coal in the world, and they have made more cement in the last 3 years than the United States has poured in 100. And so they're shipping all these goods, all these Christmas lights, all these things, products all over the world. And we continue to buy it. But yeah, you're right, Tom. It takes a hell of a lot of energy to do that. We just don't see it. Again, This is Amazon, Star Trek economy. We're kind of clueless. And I don't blame people because they just don't see what's going on.
Mm-hmm. So, Steve, when we think about, let's say, the dynamics of the U.S. oil industry, and how much of it gets exported, how does that affect our ability to have reliable domestic energy supply? And what do you see as the runway on that production?
The U.S. The supply and demand situation is quite interesting because our Gulf coasts are designed for medium grade oil, and we produce upwards of 8.5-9 million barrels a day of tight oil, which is lighter, which our refineries aren't designed to use. But we consume about 4.5 million barrels of that domestically because we import that from Canada, the oil sands, which we mix it together. They call it a Frankenblend, and we can make a medium grade. We can get diesel and different products out of it. So we export. We're exporting about 4.2 million barrels a day of our domestic tight oil because we can't really use it. The issue is maybe it would have been smart. Now, this is being selfish. Maybe it would have been smart to keep some of that production for future use. But again, that production is now supplying other countries around the world, and that's doing some GDP, right? Energy is GDP, is what it is. So even though we're importing about 6-7 million barrels a day of medium grade oil to run our refineries for our uses, we're exporting about 4. And I think that's going to start to decline when shale production rolls over. So this is the kind of strange issue. If the U.S. was smarter with its reserves, we're exporting about 40% of our reserves every day overseas. That's helped, foreign countries, but it's going to come back to hurt the U.S. shale oil and gas industry.
So, Steve, how do we go about refilling the SPR at these price levels? And strategically, can we look back on this decision now as being a net positive for the country?
About 3-4 months ago, when the oil prices were much higher, I looked at the data, looked at the fundamentals, and the global inventories continued to 5-year inventories continued to be lower. So it seemed to me, even though that Saudis and OPEC cut production, there's just a lot of demand now. And it seemed to me that would keep a bid in the oil price. Well, I got that wrong. I also said that due to the fundamentals, we would see lower natural gas prices. And people said, no, it's going to blow above 3.5, and it didn't. It hit $2.30 today. And I think it could even go lower. Again, on the short term, it's very volatile. And so I think the issue is it was probably a smart thing that we sold the oil at a higher price because we sold the oil at a higher price, about 300 million barrels. Now we're going to have to buy it back. If we continue to see a rollover in the economy and oil prices remain low and we start adding, well, guess what we're doing? We're going to kill the shale industry because profit margins are falling now because their break even's now getting close to 70. So if we start getting into 65, we're exporting 4 million barrels of tight oil and we're not making money on that. And so, yes, even though we could add to our SPR, I do not think we're going to add 300 million barrels. We may add 50, but this is going to be an interesting dynamic as the energy cliff starts to come back to haunt us in the next several years. So lower oil prices might be good for the economy and for, the consumers, but it's not good for the shale industry where most of the growth in the world came from.
Well, Steve, to that point, are we able to refill the SPR from the actual production that comes from the Permian and these shale oil basins? Or is it a different type of end product that we actually need to still import heavier oil to blend with?
Yeah, who knows? They could inject some of the light tight oil, but probably they're going to have to import that. They're going to have to import that and use that because the SPR is in the Gulf Coast area. That's where the caverns are. And so they're going to need the medium grade oil to purchase to put back in there. That's what makes common sense to me. So even though they could put some light tight oil, I think the overwhelming majority is going to have to be medium grade, and most of that's going to be imported.
Mm-hmm. So when we think about maybe being able to refill the SPR with some of our domestic oil production, which is, like the shale oil production or the tight oil, are we at or near the peak of that oil production capability right now?
I think we're getting there. And the problem is there's a lot of different analysis about the shale industry. But when I look at the data and I really crunch the numbers, Wall Street Journal came out and said since 2016, the well productivity in the Permian and in the shale industry has increased 59%. And that is true because the wells have gotten a lot bigger, a lot longer. And also they're shoving in a lot more water and fracking proppants or fracking sand. So what I've noticed when you look at the productivity in the Permian, this chart shows the Permian field starting in 2016, going to year to date 2023. What it's showing is per 1,000 feet of well lateral. And what you notice in 2016, the well average was about 6,800 feet. Now it's over 10,000. That's the average. Exxon, I did a 3.5 mile lateral. And there's a lot of 3 mile laterals that's 15,000 feet plus. And so what's happened is they're making longer wells. And look at the proppants, which is the sand. In 2016, it was 11 million pounds per well. Now it's 22. It's doubled. So this is the illusion of more oil. It isn't. We're just shoving in a lot more stuff, making these things longer. The downside, if you notice the white line, we peaked in the efficiency in 2021. It's been declining. And so this is the problem when you go to very long laterals. You don't get as much oil, especially at the longer end, at the end of the 3.5 mile lateral. And the Eagle Ford, which is the other Texas shale field, its productivity is much worse. It peaked back in 2019, and it's really falling down. And so I think this is the problem we're going to be facing, even though we will be in a plateau for a while. We're going to start to see a rollover in U.S. shale production due to what we're seeing right here in front of us. The well efficiency is starting to go in the opposite direction.
Yeah, it just seems as you increase the length of wells, you're increasing the complexity, the amount of, exactly as you sell the proppants going into them, just all of the costs associated with it get higher and higher. And that's one kind thing, of going back to your EROI idea, something that you and I have spoken about before.
So sorry to interrupt you, but you're right. And it's one thing, you're adding more production. These 3 mile laterals, geez, you get there, it's a lot more production at the front end. Mm-hmm. But now a lot of these are declining much faster. So it's I call it the Red Queen syndrome. Not only do we have the Red Queen syndrome globally, we're seeing it happening now in the shale industry. So it's bigger and better and longer and more fracking water. And now an issue that they're going to, it takes a lot of water to frack, and they have to dispose of it. Mm-hmm. And this is what's causing earthquakes. And it's very toxic water. And so and then in 2024, Biden has passed something where you can't, these shale wells can't release the methane, the natural gas. Some of it's being released. It won't be able to because it's cheaper to release it than get some kind of pipeline to store that natural gas. It's cheaper just to get rid of it. Mm-hmm. And so these are the issues that the shale industry is going to be facing in the years ahead.
So Steve, on the other side of the pond, what do inventories look like, going into this winter? And do you think that Europe possibly learned the wrong lesson from the mild winter that they had last year?
No, they didn't. I think they did learn a little bit. And this is the chart showing of European natural gas storage as of December 11th. You can see the dark blue line. That is 2023. And then you could see all the other lines. Well, what do you notice? Europe's never been totally full. This is the first time. And so they got it up to full, but then unfortunately, Mother Nature sent them a polar vortex. And all that cold Arctic air that's supposed to stay up there, like, what happens in Vegas stays in Vegas, it came down, and it put a lot of extremely cold temperatures, and they used a lot of natural gas. I think they used like 30 billion cubic feet more than in like about 5-6 days than they did in the 5-year average. So what did that do? You could see how quickly the natural gas storages come down. Well, that polar vortex has gone away. It's warmed up. They're not using as much, because you could look at this chart. You'll see in December 11th, they only withdrew 12.2 billion cubic feet. Well, the 5-year average is 18. So actually, they're doing a little bit better. And so I think with Germany cutting back on demand for natural gas, and they're also deindustrializing to a percentage, switching to other like coal and other things, they have cut back demand. And so I think they're going to make it through the winter okay. But then the energy cliff is going to come back to, hit them again in the next several years. It just doesn't stop. And so if they want to continue to deindustrialize, they could save more natural gas burning, but then that's going to hurt their economy. So these are the issues that Europe is now facing because, Tom, Europe is the largest net importer of natural gas in the world. Asia is number 2.
So does that mean they're really a canary in the coal mine for the effects of debt levels and then not really having a domestic energy production? Is this really a preview what is to come for the energy cliff when you have this dynamic of higher debts and, concurrently lower energy production?
Yeah, the countries that are the net importers of the most energy are the ones that are going to get into trouble. Like Russia is the exact opposite, even though there's a lot of people putting out negative analysis about Russia. Russia exports 40% of its oil and 50% of its oil and about 40% of its natural gas. Europe imports most of its natural gas, and Europe imports most of its natural gas. Asia imports most of the oil. So when you start getting into trouble with supply, Asia is going to be hit the most with petroleum products, and Europe's going to be hit the most with natural gas. And so this is you bring up a good point. It's a credit card, and any country that lives on importing energy, they don't have enough energy to supply them. They're the ones that are going to get into more trouble in the beginning. And the ones that are still exporting are going to be they're going to be better off for a while. And that is kind of the KISS, keep it simple, stupid kind of analogy. And so the United States right now is producing a lot of natural gas and oil. We're exporting oil. We're exporting natural gas. So we are a net exporter. We weren't that before. So we could thank Shale for that. Now, this is the last chart. And this is a great chart to conclude on. Because a lot of people say, Steve, you all in the peak oil movement have got it wrong forever. And actually, no, we haven't, because the devil's in the details, but people don't like to look at the details. So when you look at this chart, you'll notice that the conventional is in that olive color. Well, that's the good, high quality, cheaper to produce energy return on investment oil. And what do we notice about that? It's rolling over. It actually peaked in 2006. That's why it's no coincidence that we hit $145 oil in 2007-8. And then we brought on tight oil, which you see in that red. And we brought on more heavy oil, which is in the orange, and that mostly comes from Canada. And then look at that big yellow blob there. That's natural gas liquids. That's where a lot of the growth came from, especially from U.S. shale. The United States produces half of that natural gas liquids. Well, you can't make diesel with natural gas liquids. And the global supply chain, Tom, is run on diesel. That's what it is. It's not run on gasoline. And so when you understand that the diesel mostly comes from the conventional, and I believe the conventional is going to continue to roll over, even though we can bring on more natural gas liquids, this is the problem the world faces. We're starting to roll over in the high quality conventional oil. That's what really drives the global economy. And so this is what we need to understand. The devil's in the details. And again, that red, which is the shale oil, that declines 45% a year. We've got to make that up every year. So this is the things that we tend to overlook when people say, well, there's no peak oil, because look how high the production is. And what you really need to look at is that conventional, because that is what really runs the global economy.
Excellent, Steve.
And one more thing. If you look at, I didn't even mention, if you look at that the period there from 1960 to 1970, there's a reason why the price of oil stayed at $1.80 a barrel. And now it's all over the place, right? Mm-hmm. It goes up to 120, it comes down to $68. Why did it stay at $1.80 for an entire decade? And that's because we brought on all this conventional oil, so much of it from the Middle East and OPEC and around the world, that we were awash in oil. We're no longer awash in oil. We could see the conventionals rolling over. And that's why it's become very volatile. And I think, unfortunately, it's going to become even more volatile. And so I just want people to realize the price action is, we hit the energy cliff in conventional. You see, it peaked and now it's rolling over. When we start seeing the same in the unconventional natural gas liquids, shale oil, that's when prices are going to get very volatile on the upside and downside.
Mhm. Excellent, Steve. So, as you said, kind of concluding here, what are you keeping your eye on into the end of the year and in January?
Well, as I mentioned in the beginning, Tom, it's very difficult to know what's going to happen due to the massive amount of stimulus that's being added into the market, the $3.5 trillion. But that's just the United States. It's happening in China. I think moving forward, I think we're going to see a rollover in the economy because a lot of that money that was the pandemic is gone. And Americans now are using more money to saving. The savings has disappeared. They're using credit cards more, and the housing market is starting to get into trouble. And unless we have a major geopolitical or financial event, I think the market's going to roll over. I think we're likely going to get into a recession. I don't know how big a recession is, and that also depends on how much more debt Yellen continues to pump into the market. And if she continues to do that, and inflation comes back, the Fed may have to raise rates again. So who knows? We're in crazy times. And again, I think if we get a major event, we could see some crazy prices in energy and in the metals. So we're in a whole different world now due to reaching this plateau of energy production.
A whole different volatile world.
Yes.
Excellent, Steve. Well, I appreciate you sharing all of this with us today. Of course, for any listeners that enjoyed Steve's charts and his information, everything that he does is available at SRSrocco Report, either your website or on Twitter at SRSrocco Report, right?
Yeah, I do spend a lot of time on Twitter. And again, I try to provide the subscribers with the changing details because the energy is going to, there's a direct relationship with GDP and energy growth, or the opposite. If energy growth falls, you're going to have falling GDP. So when you understand that, it's going to impact everything, especially the 500 trillion in financial assets. That's why I'm a big believer, Tom, in being in real assets in the future. Investors just don't know it. And so that's what I'd like to talk about. Thank you for letting me share the time with you. And I hope everyone has a happy holiday season when it comes.
Thanks very much, Steve. Always appreciate the conversation with you.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.